let's take a look at a particular lease example and also kind of show you how to read it when you are on the exam. Parker, the lessee, so the C will not be outlined in the exercises or the exams, so make sure to write who is the lessee and the lessor so you don't get confused in the journal entries. Leases a lift from Stoughton Trailers, who is the lessor, that will be installed at the docks. The lease signed on January 1st, 2020, need this date, specifies that Stoughton grants right of use of the lift to Parker under the following conditions. And if you have a very long explanation like this, it will be kind of helpful to write down or jot down small facts so you can easily find what the terms of the lease, what are the payments, when they start, etc. Lease agreement is non-cancelable with a term of 4 years, requiring equal rental payments of $11,000 roughly at the beginning of each year. And in this case, we will be doing with annuity due basis. We have the lease that started as of January 1st, and in the beginning of each year, we will be making a payment. Sometimes, be careful, you might have a lease that was signed on December 31st, for example, 2020, and if the payment occurs right away on that same day, December 31st, even though it's the end of the year, it will be considered to be annuity due as well. The lift has a fair value at the time of the lease when we signed it of $40,000, an estimated economic life of 4 years, and no residual value. What is residual value? That's the value of the forklift lift at the end of the lease. The cost of the lift to Stoughton on the lessor books is $30,000. The lessee contains no renewal option, and the lift will go back to Stoughton at the termination of the lease. The implicit rate of the lessor is 8%. What does this mean? That means that these payments contain 8% borrowing rate that was imposed by the lessor. And Parker, the lessee, does know about the rate. Stoughton sets the annual rentals as follows. We can look at a helpful timeline right here. So currently, we have equipment with present value $40,000, and the lease term is 4 years. We also know that the lessor sets the payments so they can recover 8% rate of return on this kind of investment. And we also do know that the payments occur at the beginning of the period, so it is an annuity due. Okay. And if you think about it, we will be using the following formula. Present value of $40,000 right here equals payment that we're trying to solve for times present value factor of an annuity due with I of 4 and with I of 8% and 4 periods. We're trying to solve for the payment. If you plug in the amounts, you will end up with the following formula. 40,000 divided by 3.57710. That's a present value factor that you can find in the tables. And result will be the following rental payments that the lessor will be requiring. Our next step will be to go through the lease classification as example so we know what kind of journal entries we need to make based on the type of the lease. And going through the test, if you remember, transfer of ownership, that was actually one of the reasons why you need to read the lease agreement very carefully, because you're already subconsciously looking for all these potential tests that you will be doing later on. Transfer of ownership does not occur. because Stoughton or the lessor gets the forklift back. Purchase option test, we don't have any bargain purchase option built into the lease. Lease term is actually at 100% because lease term was 4 and economic life was 4. So you don't even have to go through the other two because at this point you already know that it will be a finance type lease for Parker or sales type lease for Stoughton, the lessor. I will go ahead and talk through the present value test just in case you will need to go into the next line as well if the answer for number 3 is no. What is the present value of lease payments? If you do the little calculation right here, so you would take the rental payments and multiply it by present value factor for annuity due with I equals 8 and N equals 4, you will get exactly 40,000, which is constitute 100% of the current fair value price of this lift. Therefore, we meet the present value test. It's greater than 90%. I do understand that this looks to be a little bit more repetitive from the calculation we just did on the prior slide. However, you do need to make this present value test because we will have some specific little nuances in the more complex examples where the calculation will not be identical to the one we did on the prior slide. And then alternative use test, the forklift could be completely used up at the end of the lease, and it will not have any use to Stoughton at the end of the lease. Our next step will be to set up a lease amortization schedule, and it will be lease liability for Parker and lease receivable for Stoughton. In this case, amortization will look identical. Again, in some circumstances, it will not be 100% the same. And if you see, the setup is very much like as what we did for long-term debt. And as you understand, or the investment if it's a receivable. So leases are debts. Therefore, the setup is the same. So January 1st, on the 20th, here is our fair market value or present value of future lease payments at $40,000. The next payment will occur right away, so we will plug in roughly this $11,000 in the very first date. So far, there is no interest that we need to worry about because no time has passed. Therefore, the full $11,000 will be a reduction to the lease liability or recognition of a lease receivable for the lessor. What about for the next year? Next year, on January 1st, 21st, we will have to pay again $11,182, and just like we did for the debt, we will be using 8%, our implicit rate, to figure out how much of the lease payment will be attributed to the interest part of it. And in this case, we will take 28,817 and multiply it by 8% to get this amount. And here's your new amount for the reduction in lease liability. And the whole amortization schedule goes down all the way through until the lease term is over. I will go ahead and discuss for now only the lessee's part, and then in the next video I will discuss the lessor's part. For the first year, as of January 1st, in this case we will have 2 journal entries. The first one to record the right of use asset. So the lessee, Parker, will record the right of use asset at $40,000 and then lease liability at the same amount. And right away, because we made the very first payment, this $11,000, $11,182 will be paid in cash. And at the end of the year, we have to not forget to accrue our next payment that will occur on January 1st, 2021. So as of December 31st, 2020, the first journal entry will be to record interest expense. Where did we get this? From this column. And the credit part will not be a note payable like we used to, or bond payable. It will be, or interest payable, it will be lease liability. And students a lot of times forget about the second journal entry for the amortization. So please be careful to remember that we have to amortize the right of use asset. What numbers will you be using for that one? You have to go back and look what was the cost of the asset, and it was $40,000. And then we have a 4-year lease term that we'll be using. Therefore, $10,000 will have to be recorded as a reduction in the right of use asset. So remember, there's no accumulated amortization, and it will be recorded as amortization expense. So there's no depreciation expense, even though the calculation is very much alike, but it's either amortization expense, and the credit is taken directly against the right of use asset. So let's take a look what will be going on the financial statements. This is the part for the presentation where a lot of times you guys get a little bit confused. So let's take a look on the balance sheet. We will have non-current asset and right of use asset at $30,000. How did we get that? We started at 40, but then remember we also amortized 10. Here's my credit. So we have $30,000 remaining. Then on the liability side, we will have current liabilities. Where is that one at? Well, remember this payment is due tomorrow, so we will have to pay off $11,182, and it is current liability that will be paid off tomorrow. Non-current liability, list liability is $11,940, so this is the amount that is right here. Okay, so make sure that you're comfortable reading this amortization schedule so you can find what will be your current liability. Here it is. And then what will be constituting your non-current liability, which is this much. Your total liability is $28,817 at the end of the year 2020. How about we'll take a look at the next year? And I added one more year on the amortization schedule so it's easier to see. Your next payment will come January 1st, 2021, and we will pay off $11,182. Here comes your payment, and it will be done in cash. And then at the end of the year, very similar, we will have to recognize interest expense of $1,595. Here's this amount, and we will accrue it, and it will be paid off tomorrow. And recognize also lease liability. I believe I might have misspoke and I said a reduction in lease liability. At the end of the year, if you can see, it is actually an increase in the liability, but then tomorrow it will go down as we pay it off. And again, please don't forget to record another year worth of amortization expense. If you take a look at the balance sheet, what do we have there? You have non-current assets, right of use asset. Now you only have $20,000 left in the account. Current liability is the same amount. It is due tomorrow. And then non-current liability is roughly $10,000. And then on the income statement side, you have interest expense that you recognize in the amount of roughly $1,500, and then amortization expense again at $10,000. Since the next two payments are very much alike to the ones that we just discussed, I strongly encourage you to pause the video, grab a piece of paper, and figure out what will be the journal entries, looking at the prior slides when I had the full amortization schedule available for you. And I will reveal the answers for years 3 and 4. Please go ahead and double check the work that you did, and hopefully you will have 100% the same answers as the one that we just did.